Good morning. So, all of these bubbles are going to pop. The financial elites are pushing a narrative that asset prices, sales, and profits are all going to return to January 2020 levels as soon as the COVID-19 pandemic fades. Come on, nothing's going back to January 2012 levels. Rather than the V-shaped recovery that's expected by Goldman Sachs, this crash in asset prices is eventually going to gather momentum. Why do we think? It's simple. For 20 years, we've overinvested in speculative bubbles and squandered borrowed money on consumption and underinvested in productivity-increasing assets. To understand why the value and the market value of assets is going to reprice lower and lower, this is a process that's going to be interrupted with crazy rallies and false lights of hope that return to a speculative good times is just around the corner. Well, let's start with the basics. The only sustainable way to increase broad-based wealth is to boost productivity across the entire economy. That means producing more goods and services with less capital, less labor, and fewer inputs like energy. Rather than boosting productivity, in the past we've lowered productivity with bad investment and by propping up unproductive sectors with tons of money that all accrues interest. Now, the poster child for this dynamic is higher education. Rather than being pushed to innovate as costs went up, the higher education university cartel passed its inefficiencies and bloated cost structure onto students who have paid for the bloat with something like $1.6 trillion in student loans that only a few can afford. As for corporate America squandering $4.5 trillion on stock buybacks, the effective gains on productivity from this huge sum is not just zero, it's negative, as the resulting speculative bubble suckered in institutions and individuals who'd been stripped of safe returns by the Federal Reserve's low interest rates forever policy. So what could that $4.5 trillion have purchased in terms of increasing the productivity of the entire economy? Well, considerably more than the zero productivity generated by stock buybacks. The net result of uneven gains in productivity and the asymmetric distribution of whatever gains have been made in stagnant wages for the bottom 90% and rising costs for everybody. Those of us who are self-employed or owners of small businesses know that healthcare insurance costs have been ratcheting higher by 10% or more annually for years. Whatever is poured into the healthcare cartels have been offset with declining lifespans, higher costs and addictions to opioids, and huge, numerous, broad-based declines in overall health. This widespread addiction to smartphones and social media has also deranged and distracted millions, crushing productivity while greatly increasing loneliness, insecurity, and a bunch of social ills. So, two dynamics define the economy in the 21st century. We have substituted debt-driven speculation for productive investment, and we have substituted debt for earnings. That's why the repricing of speculative bubble assets can't be stopped. Debt-driven speculation is not a sustainable substitute for investing and increasing productivity, and debt-fueled consumption masquerading as investment isn't a sustainable substitute for limiting consumption to what we can earn and save. All of these bubbles are going to pop. Once corporate America's credit lines are pulled and its revenues and profits plummet, the financial manipulation of stock buybacks is going to end. It's going to spend the end of a 12-year bull market in stocks. As the tide of speculative mania ebbs and confidence wanes, the world's housing bubbles are all going to pop, and $1.4 million bungalows are going to drift back down to their bubble heights around $400,000. They might even drop from there. As for collectibles and other playthings of the super rich, those bids are soon going to vanish and yachts will be set adrift.